Hi and welcome everybody. I'm Jennifer Birch with the training department here at Cornerstone Home Lending. Welcome to the CLD 411 or Correspondent Lending Division 411 for April. This is the fifth part of our VA Lunch and Learn. We are going to cover refinance options, but before we get started, let's go ahead and see if we have any messages from Angela, and then we'll go ahead and introduce our speaker today.
Actually,
Angela,
I don't have a whole lot. I think we can probably just go ahead and get into the session.
Awesome. And today our speaker is Karen. Karen, you want to go ahead and introduce yourself, and you can go ahead and take over?
Okay. I'm going to go ahead and share my screen, and then you should be able to see the next slide, which should say VA refinance options. Let me know if you guys do not see that.
Karen, you have to switch your screens. Right now
Which one
have your PowerPoint and your notes.
Oops.
So I'll have to switch those around.
Well, let's do what if I do share desktop and I do a specific monitor? Can I change that? Yeah, I can change that. All right, how about now?
Nope, still the same.
Ugh.
Oh, wait, hold on. It's changing.
Okay,
slowly.
Good. Computers are just not as fast as we are, right? Okay. Do you see it now?
There we go. Go ahead.
Okay. Yes. All righty. All right. Good afternoon, everyone. I'm Karen Ippolito, and I'm with Underwriting Support on behalf of Cornerstone's Correspondent Lending Department. And today we're going to talk about refinance options on VA loans. Now, when applicable, I've tried to apply Cornerstone Correspondent Lending overlays in this presentation for topics that we don't specifically address here today. Just a reminder that you should always apply the same criteria that you normally exercise, when underwriting any other type of refinance loan. And that would include applying Cornerstone Correspondent Lending overlays, which can be found on their specific website. So if everyone is ready, let's talk about VA refinances. So there's two types of VA refinances that we're going to be discussing today. One type of refinance is a non-credit qualifying streamline called a VA interest rate reduction, or also known as the VA IRRRL. And the purpose of this refinance is to lower the veteran's interest rate on his or her current VA loan. That is the requirement that VA states in order to do an IRRRL. So long as that veteran is reducing his interest rate, then that's the primary qualifying criteria. The other type of refinance is called the VA cash out. Now, unlike other loan types where there's a distinction between no or limited cash out and cash out, VA doesn't have that distinction. So they just have cash out refinance. And so that defines the refinance regardless of whether the veteran is actually taking true cash out or if they're only refinancing existing liens and receiving no cash out. Now, the purpose of this type of refinance is to pay off any lien or liens against the property, as well as allowing cash out to the veteran if they desire. This includes payoff of a current first mortgage, interim construction loan, or even tax liens. Now, of course, paying off tax or judgment liens would be subject to evaluation and credit acceptability. Now, VA is all about making it work for the veteran when it's possible, and you'll see that as we cover this topic today. So because of this flexibility, even though VA has a one-stop type of refinance, you're going to find that some investors, and that's including C-Stone correspondent, do make the distinction between construction to perm and term, rate term refinance, or no cash out refinance, and the difference between a cash out. So when they publish their maximum LTVs and CLTVs, they do make those distinctions. And so as a result, sometimes that can cause confusion. But if you're just aware of that, the differences, then it should help with any kind of confusion, when originating and underwriting those VA refis. So for our purposes today, when we're comparing VA IRRRL and other refinance types, then we're just going to refer to it as VA's definition, cash out. But just remember that it would include rate terms, no cash out, construction perm, that kind of thing. It'll include all types of refinances. Does anybody have any questions about that specifically? Okay, we're going to move on. All right, now some allowable closing costs that are typically not allowed on a VA purchase are allowed on a VA IRRRL or a VA cash out refi. And some of these would include, now that does include the refinances, construction perm, rate term. Again, we're talking all types of refinances when we use the word cash out. So allowable on both types of refinances are the courier fee, the FedEx fee, express mail, or any other type service, as long as the saved per diem interest cost to the veteran exceeds the cost of the special handling. So we would have charged the veteran X amount, to go snail mail, then we're going to pay the handling, so that saved him some money. So VA is just looking for it to be in the best interest of the veteran. Now, also allowable on both is the cost of the tax certificate and any wire fee to send that payoff. And here's the difference. On a VA IRRRL, we are limited to including only 2 discount points in the new loan amount versus being allowed to finance any bona fide discount points paid from the loan proceeds on a cash out refinance. A pest inspection is only required on a cash out refinance, and then the veteran is allowed to pay for the cost of that inspection. So remember, we stated cash out. So again, we meet all types of refinances when we have that, make that distinction or that term. Does anybody have any questions about allowable closing costs? Okay, when non-credit qualifying, there shouldn't be any disclosure of income, assets, or any debts other than the mortgage reflected on the final 1003 on a VA IRRRL. Now, if the initial 1003 has all that information, then that's okay. We just need to make sure that the final 1003 doesn't have those items reflected unless you are truly credit qualifying that borrower. For a cash-out refinance, since we're credit qualifying the borrower, then an acceptable VA appraisal that supports the transaction is going to be required. However, on a VA IRRRL, even though this is a streamline of an existing VA loan, correspondent lending department still wants to know that the property value will support the new loan amount. So as a result, we require at minimum a 2055 appraisal or an AVM reflecting a value that supports the total loan amount that would include the funding fee. And when an appraisal is required, make sure that a conventional appraisal was completed and not a VA appraisal. And in the instances if an appraisal was completed as a VA, then you would need to ensure that that case assignment was canceled and then a VA IRRRL case assignment is ordered, which would not have an assignment to a VA appraiser. And then you can still use the VA appraisal, but we would like to request that the VA appraiser remove that canceled case number from the appraisal to avoid any kind of confusion at time of purchase. But we know that VA appraisers can be cankerous about that, and if they do refuse, then just make good notes in the file, and then that should eliminate any questions at time of purchase. Now, as we discussed in Part 3 of our Lunch and Learn, when we were talking about credit and liabilities, any assets needed to close on either type of refinance needs to be verified and sourced. Refinances can be run through AUS, may follow the waiver of sourcing funds when the total cash to close is less than 4% of the appraised value. Now, most IRRRLs will be calculated to require no cash out of pocket. So in many instances, you won't have assets verified on these loans, but in the instances that they are needed, then verification would be required. Now, if you're not verifying assets to close, then again, another reminder just to make sure that there is actually zero cash to close required from the veteran on the final CD or the closing disclosure. VA IRRRLs are manually underwritten, and that's whether they are non-credit qualifying or credit qualifying, and they should not be run through AUS. Now, you also are not required to provide a VA loan analysis for those non-credit qualifying loans. Now, on a cash out, you can apply the same underwriting options as you would on purchase transactions. So that means with either the loan being ran through AUS or manually underwritten. Now, to be eligible for VA IRRRL, the original veteran doesn't have to currently own or occupy the property, but he must still own the property and be entitled. What we do have to make sure is that the parties to be obligated on the new IRRRL are eligible compared to how the original VA loan was closed. And so this is going to be accomplished by obtaining a copy of the original note confirming the original obligors, and then referring to this chart, which is available in the VA Lender Handbook, to help you identify whether an IRRRL is possible. Now, although VA doesn't require credit qualifying on an IRRRL, when there will be a change in obligors, if a change in borrowers is occurring and an IRRRL is still possible according to the chart, then always make sure that there's a letter of explanation, obtained from the borrower. So, for example, addressing the ability for him to make payments, or her, on the new loan without the co-obligor's income, such as in the scenario of a veteran and spouse that were on the original loan, and then now you have a divorced veteran alone on the new IRRRL, and then this is a scenario that's going to be on line 2 of this chart. Or when there's an addition of a different spouse than the one on the original note, and then that would be a scenario that's outlined on line 3 of this chart. Now let's walk through some scenarios where it won't be possible to do an IRRRL, just to give you an idea, give you a good feel about the eligibility. If you look at line 7, the divorced spouse is keeping the home and then wants to refinance, but the spouse can't go on the IRRRL loan unless the veteran agrees to be obligated on the new loan and then commits his or her entitlement, since a person without entitlement can't get an IRRRL or any other type of VA loan, so that would not be eligible. The only exception to allowing only a spouse to close on the loan would be in the case of a veteran and spouse who were originally on the note, and then the veteran subsequently dies, and that's a scenario outlined on line 5 of the chart. And if you look at lines 8 through 10, the applicants here cannot obtain a VA IRRRL, and that's just simply because they're not the veteran. So on line 8, case of an unmarried veteran who was on the original loan, the marriage and death of the veteran occurred after the loan was made, and then the deceased veteran spouse was not originally obligated on the loan, and thus she would not be able to proceed in doing a VA IRRRL. On line 9, in case of the veteran and spouse obligated on the original loan, the divorce, remarriage, and then death of the veteran occurred after the loan was made, and then the deceased veteran's new spouse obviously is not obligated on the original loan, and then therefore would not be able to move forward with an IRRRL. And so if there's any other type of scenario addressed that you run into that's not addressed here, then we would ask you to reach out to your local VA office and then go through that scenario with them, and then they would make the determination on whether you can proceed with an IRRRL. So now this is a lot of information here, so I do want to stop here. Does anybody have any questions regarding eligibility as far as parties? or concern? Okay, good. All righty. So we're going to move on. K-bars. Now remember, again, in Part 3 of our Lunch and Learn, we determined that all VA loans require a clear K-bars number, and this includes VA loans. So unlike a purchase or a cash-out refi where the number would be reflected on the loan analysis, on a VA IRRRL, the clear K-bars number should be noted on the IRRRL worksheet, and that's the worksheet we do to calculate our loan amount. And, of course, we look for that to match the actual K-bars number found on the printout that you provide to us. And we're going to discuss the VA IRRRL worksheet in a little more detail in a moment. Also, if you remember from Part 3 of our series, any K-bars hit for a payment of a claim by FHA on a previous loan can be disregarded and considered clear if we are past VA's required 2-year foreclosure wait period. So for FHA, that K-bars claim is going to remain on there for the 3 years because that's what they require. But for VA, if we can document we're past the 2 years, then VA states that you would be okay to proceed so long as we have the file documented. Now, if the K-bars has any other type of hit, even though there's no credit qualifying, the veteran is still going to be required to either pay off the delinquent federal debt, or they're going to need to provide evidence of being in an acceptable repayment plan in order to proceed with an IRRRL loan. Now, the case assignment for a cash-out refi, it's required the same as for a purchase transaction, except the case number reflects the transaction as a refi with the appraisal or the appraiser assignment for the completion of the appraisal. Now, on a VA IRRRL, while we have a conventional appraisal completed, there's no VA appraisal ordered. And this is a common mistake sometimes when we order the case assignment and the appraisal on a VA IRRRL. So to verify we have the right case assignment ordered via the Webology, we can look at the very top of that case assignment, and there you'll see IRRRL ordered successfully, just to know that we've ordered the correct type of case assignment. Now, the case assignment should be relied upon only for determining whether the veteran is exempt from the funding fee or for verification of the monthly income received from VA if you're credit qualifying. So for the original interest rate and term and loan amount, you should obtain and rely on that original note. And the reason being is the information on the case assignment is tied to the input from the previous lender. So obviously that information could be inaccurate and we wouldn't want to rely on it. And in this case here, the veteran funding fee is exempt, so no funding fee would be charged on this transaction. And then if we were credit qualifying the loan, then we could use this case assignment as verification of the VA income being received of $1,289.39. And then, of course, always make sure that the property address is reflected correctly. Now, on a VA IRRRL, the borrower can receive cash back up to $500 when due to those incidental changes in payoff and escrow requirements. However, for loans inside Texas, no cash back can be given to the borrower over and above any documented POCs. Now, on a true cash-out loan outside of Texas, the veteran can, of course, receive any amount of cash back after all the eligible liens are paid off. And then for loans inside Texas, a borrower wishing to receive any cash back over and above those documented POCs would have to close conventionally as a Texas cash-out refinance. Now, the only exception to that cash back greater than $500 on an IRRRL is when it's for reimbursement to the veteran for up to $6,000 of cost energy-efficient items that veteran might have completed within the 90 days immediately preceding the date of the loan closing. So this is not common due to that tight qualifying period, but in case you ever run across that scenario, if that's a good piece of information to know, that you might be able to include that amount. Now, VA does have an approved condo list. However, on a VA IRRRL, a certification that the condo is VA approved is not required. A cash-out refinance, which includes those rate term refinance, any refinance, However, that would be required to be on VA's approved condo project list, and that is available on VA's portal. With the exception of the K-Horse pool, VA IRRRLs are non-credit qualifying, and VA doesn't require any additional credit docs. You will, however, need to obtain a mortgage payment history to determine whether the loan meets Safe Harbor QM status. And then if the monthly payment, PD payment, increases by 20% or more, then VA requires us to determine that the veteran qualifies for that new payment by documenting the borrower can support the proposed housing and recurring monthly obligations, as well as verifying stable and reliable income by calculating that ratio and residual income. And then in that case, you would need to have that loan analysis completed. As long as the mortgage payment is satisfactory and your ratios and residual are acceptable and there's no significant adverse credit in the most recent 12 months, then the veteran should be found creditworthy. If the borrower is currently in Chapter 13, then the borrower will need to meet VA's bankruptcy credit criteria and receive approval from the court for entering into that new refinance. Now, because the proposed payment is increasing exceeding the previous payment by 20% or more, then VA will look for the underwriter to include a completed loan analysis and to certify that that veteran qualifies for that new payment. In order for an IRRRL to be considered safe harbor, then the loan's going to have to meet additional requirements, and then we're going to cover those a little bit later. Does anybody have any questions so far on what we've already covered? Okay, we're going to keep going. Okay, for all IRRRLs, the veteran must sign a rate reduction certification acknowledging the effects of the refinancing on the veteran's new mortgage versus that of the previous loan payment, the interest rate, and how long it would take to recoup all the closing costs and funding fee. Now, that includes both included in the loan, financed, and those that are paid outside of the closing. It doesn't include prepaid, so VA made that clarification not too long ago, so that was good because we had many of our loans didn't pass that when we had to include prepaid. So it's just actual closing cost, whether they're financed or paid outside of closing. And to be QM eligible, the max recoupment is 36 months, unless, of course, they're refinancing an ARM to a fix, or you have a fix to fix at a shorter term. If there's any changes to be made to the payoff or closing costs, this form is going to needs to be re-signed by the veteran to acknowledge change in payment and then correct the number of months to recoup the closing costs. So you'll need to remain alert and ensure that your production is going to ensure that that certification is amended accordingly and that the veteran is going to sign that prior to closing. And then we're going to visit this form again as we continue. Now, for a cash-out refinance, the borrower will need to have sufficient entitlement as evidenced by the certificate of eligibility. So one important thing to note here is if the existing loan being refinanced is a VA loan, then the certificate of eligibility has to reflect that it's valid for refinancing that specific VA loan number. And you'll see right here what we're looking for on that certificate of eligibility. If it's not on there, then you know that that certificate was not ordered properly, and they're going to have to go back in and make sure that it's ordered correctly. The only time you won't need a certificate of eligibility is on a VA IRRRL. And, of course, the reason is the veteran is just simply substituting his eligibility from the existing loan to a new loan with a lower interest rate. And then when the IRRRL case number is ordered successfully, it takes the place of the certificate of eligibility, and then that serves as your authorization for that new transaction. Now, as with purchase transactions, the funding fee for a cash-out refinance is dependent upon whether the veteran is a first-time user or a subsequent user of his or her entitlement as determined by that entitlement code. The COE confirms both the entitlement code and whether the veteran is exempt. So the important thing to remember is that unlike a purchase transaction where a down payment can be used to reduce that funding fee for the veteran. VA does not allow the use of equity on a refinance to reduce the funding fee charged on a refinance. So it's either going to be first-time user or subsequent. It's not going to be anything in the middle. Okay, income is fully verified on a cash-out refi. So, however, in the order for a VA IRRRL to be considered QM safe harbor, the loan must meet the following requirements to remain exempt from being required to verify income. So I have the bullet points up here. It can't be currently past due, which we are already verifying good mortgage payment history. The proposed IRRRL doesn't increase the total balance on the existing loan. Your points and fees are in line, the 3%, and the interest rate on the proposed IRRRL is lower than the interest rate on the loan being refinanced, unless, of course, we're doing the ARM to fix. And then the proposed IRRRL is fully amortized, so we don't have any balloon payments. We don't have any variations in interest only or anything like that. And then the loan, of course, as long as it meets any other current VA requirements. Now, there's 2 additional criteria with respect to mortgage payment history and seasoning that also must be met for the VA IRRRL to be considered safe harbor, and then we're going to cover that when we get to those topics. So when the VA IRRRL does not meet this criteria, then the loan is going to be considered rebuttable presumption, and then income is going to need to be verified, and ratios and residual income will need to be calculated. Like any other refinance, the rate on a cash-out refi is negotiated. However, to be eligible for an IRRRL, just like we had been saying, lowering the interest rate is the purpose. So unless refinancing an existing ARM loan, always ensure that the rate on the new loan is going to be lower than the existing or previous VA loan. Now, we accomplish this by reviewing the interest rate on the original note and then making sure that the VA reduction certification that's signed by the veteran is accurate, and then it's signed prior to closing. And then we are going to visit this form yet again as we go through this slide presentation. Now, for both IRRRL and cash-out refis, the veteran must currently be entitled prior to closing. So for VA IRRRL, the veteran must also be an obligor on the original note. Now, the veteran can only refinance the VA first lien into the IRRRL. So all subordinate liens will need to be subordinated, and the only exception to that would be a Texas veteran land board loan. So those, I'm told, can be included. But if you do have that type of situation or scenario, I would still reach out to VA at that time just to confirm that that is still an accurate statement. On a cash-out refi, the proceeds of the new loan can pay off any type of lien. So that includes first and second liens, interim construction loans, and then even tax liens can be paid off when the veteran's credit is otherwise acceptable. The veteran cannot take cash out on a free and clear property. So there has to be some type of lien to pay off in order to originate and close a VA cash-out refi. So even if the judgment is the only lien filed against that property, then for VA's seasoning or eligibility purposes, it would qualify as long as the veteran's credit is otherwise acceptable to do that. Now, just like purchase transactions, the veteran must have sufficient entitlement to cover the new loan amount on a cash-out refi. Now, a veteran with partial entitlement or with a loan amount above the county loan limit, they must have enough equity plus the available entitlement to ensure that a minimum of a 25% guarantee is going to be obtained on that cash-out transaction in order for it to be saleable to CLD. As a reminder, always double-check and make sure that the calculations are based on on accurate information. And this is especially critical when the final loan amount is less than $144,000 when that bonus entitlement is not applicable. And that way, yet it may be inadvertently included to determine eligibility and cause an issue at purchase. Now, the maximum loan amount on a VA IRRRL is calculated as follows. And it's going to be line 1 is going to be the existing VA loan balance, and that represents the total payoff of that's included, plus the cost of any energy efficient improvements up to $6,000, less any cash payment from the veteran if he paid anything out of pocket, plus line 5 up to 2 discount points. Then plus line 7 is going to be the 0.5% funding fee when applicable, and then line 8 is going to be your other allowable closing costs and prepaids. Now, the total of line 5 and 8, less prepaids, should match to the total closing costs being used to calculate the number of months to recoup on that VA rate reduction certification. So when applicable, make sure that 0.5% funding fee is added back on line 17, and then line 18 should equal the max loan amount, to which should always be rounded down to avoid that veteran getting any cash back. And if you're an underwriter, then you should confirm that this worksheet is properly completed and that the loan amount is accurately calculated, and it's signed and it's dated. Okay, as I mentioned in the beginning of this presentation, even though VA has a one-stop type of refinance, Correspondent Lending Division does make the distinction between construction to perm and rate term, no cash out, and cash out when they're publishing their maximum LTV and CLTVs. And so here's just a reminder of what those maximums are. CLD will purchase conforming IRRRL loans at 100% LTV. That includes the finance funding fee. New subordinate financing is not allowed. However, for the existing in-place subordinate financing, there is no CLTV limit. And you can refer to those overlays if you need assistance in determining those maximum conforming loan amounts. And then for refinances paying off construction loans, or rate term resulting in no cash back, we will go up to 100% LTV CLTV, and you would be able to finance the funding fee on top of the base loan amount. For cash out refinances where the veteran is receiving cash back greater than $500, then the maximum LTV or CLTV is 90% excluding the funding fee. On a cash out, generally no more than 1/30 in the most recent 12 months is acceptable, since anything more than that is going to require a downgrade and subject to a manual underwrite, unless there's some type of extenuating circumstance there. On a VA IRRRL, to be QM Safe Harbor eligible, the borrower must have made at least 6 payments on the existing VA loan, and he cannot have had any late payments in the most recent 6 months at the time of the closing of the new transaction. Now, correspondent lending will accept either a 3-merged or mortgage-only credit report with FICO scores that reflects the life of the loan mortgage payment history with no less than a full 6-month payment history. Another VA required form is the VA IRRRL prior loan current loan certification, and this form certifies that the loan is not currently 30 days or more delinquent at the time of closing, and that certification is made by you at the time of closing. Net tangible benefit form is a requirement on all of our refinances, so just reminding everyone for the need of this form on every refinance loan. If you are in a state that has a state-specific net tangible worksheet, then of course you would use that one. The property does not currently have to be owner-occupied on an IRRRL refinance to be eligible. So the veteran can be renting the home, or it can be functioning as a second home. As long as the veteran or their eligible dependent or child of the veteran or the spouse of an active duty veteran certifies that he or she did at some point previously own or occupy the property as his or her home, then that should be sufficient. This certification is made on the VA rate reduction certification that's signed by the veteran prior to closing. This is different than the requirement for cash-out refinances with a veteran or the eligible spouse, dependent child, or other eligible veteran would have to intend to personally occupy the property as his or her home. On VA purchases as well as cash-out refinances requiring credit qualifying, prior VA approval is required when the veteran is receiving non-service connected pension and or is being rated incompetent by VA. Now, or you closing a joint loan between two eligible unmarried veterans and they're both using their entitlement. However, on a VA IRRRL, that prior VA approval isn't required for veterans who are receiving that non-service connected pension, nor for veterans that are rated incompetent by the VA. So since the entitlement is being substituted, there wouldn't be a need for prior approval for entitlement purposes. This would still be true even if we needed to credit qualify the veteran for that new payment. However, VA would require prior approval if the IRRRL did not meet the income exemption requirements for that safe harbor. I'm going to just stop here. Does anybody have any questions on anything that we have covered so far? Okay, let's move on. On a cash-out refinance, we were already determining whether the veteran qualifies for the new PITIA payment, so there is no further consideration. But on an IRRRL, the proposed PITI payment must be compared to the original PITI payment of the existing loan to make sure that the new payment is not going to exceed by that 20% or more, which would require credit qualifying, and that the correct number of months to recoup is being calculated correctly, and that recoupment is no more than 36 months to keep it safe harbor. Now, the PITI payment on the existing loan used can be used from the credit report. If there's any question on the accuracy of the actual PITIA payment based on your comparison of the original note and the current insurance and taxes being used, then obtaining the most recent mortgage payment coupon may be in order to confirm an accurate current PITI payment and that it's being, the one that's being used for comparison is accurate. This dollar figure should be entered into the VA rate reduction certification form signed by the veteran. And remember, if any changes are made to the payoff or closing costs, this form needs to be re-signed by the veteran to acknowledge those changes. On a cash out, among the few unique features of a VA refinance is that seasoning requirements are like the easiest to remember, and that's because for a cash out there is no seasoning requirements. So the veteran can be entitled one day. As long as it meets all the other requirements, then it's eligible. So there's no seasoning there. No minimum number of months to own land on a build-on-your-own transaction. No minimum months before a subordinate lien can be refinanced. No minimum number of months for a veteran to be entitled. So, for example, we had a question last week involved a veteran who recently married and his new wife was residing in the home where both the debt and title were in the wife's name alone. So the mortgage was delinquent and the veteran wanted to use his entitlement to refinance the mortgage. So normally we would look for the veteran to be both occupying and entitled for at least 12 months before being eligible for any other type of refinance, but for VA this was acceptable because there was no seasoning, and in this particular property it was in a non-community property state. So had it been in a community property state, then we probably would have had to consider that non-purchasing spouse's credit to a certain extent when considering that loan for approval. On a VA IRRRL, in order to be considered safe harbor, it must have that 6-month seasoning, which is calculated from the origination date to the new note date. But in addition to that, don't forget that we have to have that 6 months of full payments. So probably the 6 months of full payments is probably going to be trumping the 6-month seasoning, since we'll have to have that in play as well. For cash-out transactions, as with any other loan type, can have a term up to 30 years. Now for a VA IRRRL, however, the maximum loan term is the original term of the VA loan being refinanced plus no more than 10 years, and of course not to exceed 30. So this is different from FHA streamlines if you do FHA, where they use that maximum term as the remaining term plus 12 years. So an example of this would be if the veteran currently has a 15-year loan term, then the maximum term on the new IRRRL could be no greater than 25 years. So 15 years on the original term plus the 10 for a max of 25. The term of the existing and proposed loan is found on the VA rate reduction certificate. So you would compare the term on the original note to the term of the proposed loan to make sure that they are both accurately reflected, and of course that the proposed term does not exceed the original term by that 10-year max. Now the veteran can always shorten the term, but if they do, then the proposed PDA payment is 20% or greater than the existing PDA payment, then this would require credit qualifying that veteran. So you should also check the original note to make sure that this is correctly reflected on the rate reduction certificate. Now, even though VA has flexibilities when it comes to refinances, if the veteran discloses that the property as his primary residence, then we need to make sure that all the facts given indicate that that veteran will continue to own or occupy the property. While the VA IRRRL refinance doesn't require that the veteran currently own or occupy the property, you should still look to see that the actual occupancy is disclosed properly and that the loan is being sold correctly. Sometimes pricing is affected by that. Now we've seen a number of instances where borrowers complete an owner-occupied refinance with no intention of continuing to own or occupy that property. So on owner-occupied transactions, the borrower signs an occupancy statement at closing, or should be, stating that their intention to own or occupy that property for the minimum of the first 12 months post-close. Now, regardless of the type of refinance, we just always need to be alert to whether the property is currently listed for sale. So make sure that we're reviewing the subject property photos and remain alert to any kind of letters of explanation that may disclose a contradictory type fact that would state otherwise regarding his occupancy intention. And like any other credit qualifying transaction, a cash-out refi is going to require a full underwriting package, and that includes income and assets and credit and appraisal. And then for a VA IRRRL, since there are several forms and additional information that VA requires, I just kind of put this here as a recap, as a reminder of those items that should be in that IRRRL loan at the time of purchase. And so hopefully this would assist you, when you're originating and underwriting these loans, just to ensure that you got all your T's crossed and your I's dotted. And here's some additional resources that are available when you're underwriting VA refinances, and that's just we have the CLD website where you'll have your overlays that you can refer to, and then of course VA Lender Handbook Chapter 6 is where they talk about refinances, and then of course the VA website. Okay. Well, that's all I have to share about refinances today, and I hope that I've been successful in helping you understand VA refinances. So before we go, if anyone has any questions or if I can clarify anything on what we covered today, please feel free to speak up or put your question in the chat. And then I'm going to turn it back over to Jennifer if no one else has any questions.
All right, perfect. Thank you, Karen. And if we don't have anything further, I believe that is actually it for today. Thank you for joining our call, and we look forward to speaking to you next month. Thank you.
Goodbye.